It's Andrew Giovinazzi here now to talk about money management and a risk plan, and we'll wrap up the end of this silver course. So first, right, building a money management plan, right? What you want to have happen is give yourself enough cash to be able to operate in every market. So one of my golden rules about money management is you always want to be able to put on a trade the next day, okay? Which means you're going to have to keep some money allocated to cash, you're going to have to keep some money allocated to your positions, and you're going to have to make some decisions on those allocations. Okay, so first off, you have to figure out how much money you've got to work with. What's going to be the size of the account? Okay, and we'll talk about this a little bit too. What's your goal rate of return? Because that is going to also set the types of positions that you put on, right? Again, we've already discussed entry and exit. So the idea is what these positions could produce for you. So you have to know that ahead of time, and that fits into your management plan, right? How are you going to allocate money to achieve that return? Okay, and also without your account blowing up. So it's nice to wish and hope things away, but the reality is you have to manage the risk of your account so you don't wake in there and all of a sudden the next morning all your money's gone because the market did something you didn't expect. Okay, that's why we keep money in cash. Lastly, right, you're thinking, is my plan efficient, as in, am I using my capital in an efficient way? Right? Is it scalable? Which means, can I go from a 5 to a 10 to a 15 to a 20 lot if I actually start to get the hang of this a little bit and I understand the market and conditions enough to continue to scale up a little bit. Right? So different accounts warrant different approaches to trading. So what does that mean? That means is, how am I going to allocate, let's say, short gamma versus long gamma type of positions, right? And when you think about it, you're like, okay, well, if I'm short some premium over here and I'm long some premium over here, it's helping you figure out to sort of achieve some sort of balance. You don't want to sort of put all your eggs into one basket. Oh, okay, all I do is have income generating trades. If you have only positions that produce positive theta, you're going to have some days where the drawdown might be a little bit more than you want. So you have to understand how to put some sort of balance with your trading. So while the silver course is introductory, what we recommend is you need to have balance. If you're a long only trader, that's fine, right? As long as you can afford to be long, right, much longer than the market allows you to be. All right, so those are all important things to think about. Is risk management is always about, and capital management is not about the things you expect to have happen. It's always about the things you don't expect to have happen. Okay, so there's no money that's throwaway. Okay, every dollar matters. You know, and when there's also, you know, when you have short option contracts and people say don't close them because you're wasting money, you're not wasting money. Okay, if you had a profitable position, you're closing and taking risk off. Okay, which means we're not throwing those dollars away. You are taking money off the table, and that matters. Okay, so let's see some realistic rates of return. Okay, if you're trading and you can make 5% a month on capital compounded, that's 80% a year. I think that's great. Okay, that's a huge number after commissions. Okay, 2% a month is 26%. How many times does the S&P 500 return 26% per year? Not many, right? So once you start thinking about it in this way, what are the kind of trades or what kind of positions can produce those kind of dollars for you? And all of a sudden now you have a much better concept about, you know, time spreads or butterflies, or any kind of, even when you have those positive theta positions, how much you need to allocate to actually make those things work and to try to generate some of these dollars. Okay, being realistic is the most important thing you can do trading. Okay, being realistic and understanding the limits for risk control and understanding your own risk control keeps you from making silly mistakes in your thinking forward. If you think you're going to walk in there and generate 10% a month every month, good luck. Okay, good luck. Think about the best fund managers, the best hedge fund managers, the most successful managers over time. Okay, that's total pie in the sky. All right, you certainly can have periods of time where you can really outperform, right? We do it in our strategy letter yearly. We have a couple of months where we just kill it, right? But there's also going to be months that are flat, okay? So you have to take that into account, okay? What I do, how much of your account should stay in cash? I like to keep 50% in cash all the time. And that's assuming full margin on all the stuff that I have on. And I always want to have cash because you just never know what's going to happen. So some of the times, even for trades that you're interested in, you know, when the market starts to flex really high up, you know, really starts to fly or really falls apart, the opportunity for you to deploy capital, right, especially if you're starting to look at volatility, you're a little bit more conscious of the conditions, right? Being able to hold capital back and deploy it when you want to is a lot more powerful. You have a better shot at making some decent money, okay? And also, you know, if you're not having a trade on is also a position, right? So what you're doing is you're trying to look at your cash management, the amount of cash you keep on the side, and looking at that realistic return. You know, 2-3% a month, great goal. Okay, that's a goal, a target. Now you have to figure out how to get to that number. And as you get better, you should be able to kind of move around your mix of how you allocate capital. But you're always keeping money in cash, and you're always fully margined, as in you fully margin out your cost, essentially. So we talk about that. Fully margin means it's not that you use your full margin per se. It's that if you sell a put, okay, you're all in for the value of the put to zero on the stock. Okay. Worst case scenario, you're always trying to build in safeguards for yourself and be as conservative as possible because it's easy to take on more risk. Okay. But once you've put risk on, it's hard to take it off. All right, so we would start kind of from the conservative side and we work inward. Okay. Too much of a good thing. That means what? All I have is these income generating trades. I sell put spreads, and then when the market falls apart, I sell call spreads to try to pay for it, and then the underlying blows up in my face, and I make money on my put spreads, but then I get wiped out on my call spreads. Okay? You have to be a little more cognizant. You just can't sell options willy-nilly. Right? You have to have some risk management. That's why when we talk about being diversified, owning some contracts if you're short lots of spreads. Okay? Something to offset the other side. Now, from a vol point of view and in the silver, you're always kind of looking for edge. You're looking for things that are interesting. You're looking for stocks you want to own. Okay? But you also have to be reasonable and thoughtful about how you manage the risk of those positions. Okay? You want to, like I said, you always want to know what that max loss is in catastrophe. What I'm saying is you're always thinking about you're keeping the maximum dollars available for margin. That gives you a lot more room to maneuver. Okay? If you use just small dollars to margin a fairly risky position, your chance of tapping that money out is very solid, and then you're going to have big issues. Okay? Like I said, always be able to trade the next day. If you put a position on that jeopardizes that, you know it's too big and you know it's the wrong thing. So again, if you're conscious and you're thoughtful, right, and you do this in a mindful way, right, as you set up some safeguards for yourself, it gives you a better shot at success. Okay, from an option point of view, we don't like clients to be short units, meaning you're just not net short a lot of contracts. If you've never sold contracts before and you've never seen them blow up in your face, okay, I've sold a lot of contracts in my lifetime and I've seen them blow up in my face. I know how I react. Okay, I understand how I respond already, right? Because I have practice. The first time you do it, you're not going to like it. Trust me. So what we do is start by trading spreads. Start by trading or looking at things that are manageable for you. And the only person that's going to really know that is you. You got to look in the mirror and understand. So what we do is if you want to sell spreads, own some contracts somewhere else. So net, the whole basket should work. But you're never putting yourself and your capital at risk. Unnecessary risk, I should say. So you have a money management plan in place and you evaluate it, right? So the idea is there too much concentration on short premium on one side or another? What's your net Vega exposure? Remember, positions at a VIX at 12 look a lot different when a VIX is at 30, okay, as far as the market goes. Right? Do you own any what we'll call long realized exposure, meaning what happens if the market really starts to move? Right? Do you have enough cash? Do you have enough insurance? Do you have a couple of SPY puts laying around? Okay. You have to think about all these things, how they're going to work together, and you have to do it before you execute your trade. Okay, so before we go into putting that plan together and talking about a scalable plan, just leaving you with these things, these key things in mind. So as far as an important slide goes, this is an important slide to just keep kind of and put away and remember. You're trying to organize your thoughts, like I said, prior to execution. And Mark will walk you through laying out that plan here in just one moment.